Ladies and gentlemen, thank you very much, Frank, for your kind words. Much appreciated. It's great to be back at LuxCMA Capital Markets Day. Very important annual forum for the Luxembourg Capital Market participants. I think a lot has been said and written, and again, we just heard Mr. Max about the competitiveness of Europe and what can be done, of course, to improve it. By the way, there are very interesting figures I heard about very recently I'd like to share with you. We estimate existing barriers in Europe's single market to be equivalent to a theoretical tariff of 44% for manufacturing. While between US countries, the equivalent would be 15%, 1-5. This is only for manufacturing. And that tariff equivalent for services between EU countries is estimated at 110%. 110% tariff equivalent for services between EU countries. These are really staggering numbers that really illustrate how much income Europe leaves on the table. So the single market could clearly support a much faster growing and more resilient, innovative and competitive Europe. But there are, of course, other barriers. And one of them was also mentioned by Mr. Marx. Clearly in Europe, we lack an investment culture. And some estimates indicate that European savers have placed, as it was also mentioned, 10 trillion in bank deposits. But if only half of these savings would instead be put to work for European economy, I think the European capital markets would look a bit different today. So to discuss this topic, I'm joined on stage by someone who is a great supporter of the European project, of the euro and European markets. Kalin, I think you deserve today a round of applause. Especially as Kalin really makes an honor to be with us today on his second day of parental leave. Thank you, Kalin. So we have invited him to share the European perspectives and his thoughts on recent market developments, which may, by the way, suggest a new area for Europe. Kalin, again, welcome on stage. It's a pleasure to have you. And as our friend Holger just mentioned, we will start with the outperformance of European capital markets. This year, at least so far, European capital markets have delivered a remarkable turnaround. European small and mid caps have surged plus 10%, plus 11, well, almost 11%, plus 10.7%. While in the US, we are observing US companies down by 2.4%. On the fixed income side, of course, there's a much lower borrowing costs and ECB rate cuts, which are also supported this strong performance for Europe. But in your opinion, what do you think are the main drivers for this very positive trend in Europe?
Thank you, Julie, and thank you for having me. And Holger, a poolside chat goes with cocktails, so I hope some gin and tonics or seedlip, for those of you that don't drink, will be served to the audience to make it a real pool environment. And it's great to be here, Julie, and yes, at 4 o'clock I need to pick up my kids. I promised them to do that, so we need to do it a really fast poolside chat. But let's dive into content, because that's what you all are here for. You're absolutely right. The start of the year the consensus was Europe will do bad, US do fantastic. That's, for those of you that follow Davos, everyone running out of Davos was saying that is the main investment narrative. If you look at reality, the world is completely different. So the first 6 months of this year, the US was underperforming Europe, and Europe not only outperformed the US, but also outperformed the world. So I look at equities, I also looked at debt capital markets, and also at ETFs. We have seen the largest switch out of the US in ETFs and switch into the euro, which I think is a huge change that is following this geopolitical change in the White House. The second aspect is that German bonds, for example, are outperforming US treasuries, which is something that we never would have thought at the beginning of this year. Now, you asked me what drives this. If you pointed to one thing, it's uncertainty in the US. The US administration has been flip-flopping on their policy agenda, monetary agenda, fiscal agenda, tariffs agenda. If you look at Europe, we start to become the safe harbor for strong stability or for a peaceful legal setup. So we seem to be the investor's choice that actually is outperforming. And there is more. I think when Europe is threatened externally, like by the US, we do more things ourselves. So the new Commission started this year and launched 4 key initiatives. The Defense Union White Paper, the Savings and Investment Union, the Clean and Industrial Deal, and then finally the Single Market Initiative. So within 3 months of the new Commission that started in December, by beginning of March, those 4 initiatives were launched and included the 800 billion defense finance package, which is 650 billion nationally, 150 billion through a European product. That convinced markets. So the moment that these things were launched, we saw spreads a bit go up and now tightened, and the market said, well, Europe actually can do it. And for me, there's one tagline. This year, I think Europe really beats market expectations.
Thank you very much, Kalin. But I think beyond these 4 initiatives, there's also a quiet revolution in Europe capital markets, which is linked to the emergence of truly pan-European safe assets. So for those who may not know exactly what we are speaking about EU, ESM, and EIB bonds, which now amounts to more than 1 trillion euro in cumulative issuances. These high-quality instruments are becoming really foundational to Europe capital markets architecture. And maybe these are also one element that contribute also to Europe outperformance to the US. What do you think, and what impact at the end this borrowing activity have on European capital markets?
I think it's huge, and I think it's a huge impact because we finally are starting to have a credible competitor to the US dollar. So European safe assets, I think you mentioned them all, EFSF, ESM, EIB, and EU, were kind of negligible if you look 15 years ago. 400 million in the market, mainly European Investment Bank, a bit of EU, and then our institutions, EFSF and ESM, had to be created. In 15 years' time, we crossed last year 1 trillion. We are now 1.4 trillion. It makes us the 5th largest country in Europe. So after Germany, France, Spain, and Italy. Spain has only 1.6 billion in the market, so we very soon will be surpassing Spain as a capital market. Now, why is that important? As a global investor, you can buy a bit of France, Germany, Italy, Netherlands. But if you want to diversify and buy one asset that truly represents Europe and is a safe asset, AAA rated or highly rated, there is pretty much one choice. You go for one of these E-names. All of them have EU ISIN codes. That gives you the stability. The second aspect is, on the long term, it creates this benchmark for corporates. So we have this example from the Euro crisis where Coca-Cola was registered in Athens. Euro crisis happened, they moved their registration to Amsterdam because they were pricing off the sovereign curve of Greece. If you have a European sovereign curve, which is these E-names, whether you're based in Paris or in Vilnius or in Sofia, you can price yourself out of that. So I think this creates this truly integrated European common market. And I think for everyone, the coolest thing, all these European safe assets are coming out of Luxembourg. Because our funding teams, so the EFSF, ESM, EIB, EU, are all based in this country. And the second cool thing is they're all trading on Euro Stock Exchange. So that, I think, is a true example how we are at the heart of Europe.
Yeah, thank you very much for this. Indeed, we can be proud of all this activity out of Luxembourg, but and which contribute, of course, to the attractiveness and competitiveness of Europe at the end. And this raising the attractiveness of Europe so well triggers, of course, an increasing popularity of the euro. And there are clear signs in the market that some investors are now really considering decreasing their exposure to US dollars assets. It was yet mentioned yesterday by Christine Lagarde at the occasion of her bank's annual conference in Portugal. And she said that 2025 may be turning point for the world financial system in this context. So what do you think, Kalin, this could mean for the euro and the role it plays in the global finance? And do you really think that the euro could challenge the US dollars as the world's reserve currency, de facto at least?
The answer to that is yes, but I'll tell you first a historic perspective, and then I'll go into details. So, who of you knows what the world reserve currency was in the 17th century? Anyone? It's a LuxCMA test, otherwise you cannot be a member. World reserve currency, 17th century. Sterling? Almost. That's in the 18th to the 20th century, but very close. Sorry? Exactly. So it was the Dutch guilder that was the largest reserve currency in the world, because in the 16th, 17th century, this was the richest country in the world. It had the biggest stock exchange in the world, and the East India Company was the largest market cap company in the world, and therefore the guilder was the global currency. It was taken over by the sterling and then by the US dollars. So reserve currencies over history change. So I do think that there is a change possible. Now, if you look at the US dollar, it has been in decline since the 2000s. 1999, around 73% of the global reserves were in US dollars. Last year, 58%. So there is a sharp decline in the US dollar in holdings globally by central banks. The euro is stable around 20%, so it is the second largest. And then we have seen some increases in other currencies that are gaining popularity, like the renminbi. Now, if you look at reserves last year, the gold standard is going up, so gold holdings are going up. But as a country, you cannot really issue gold. So then the euro is probably one of the best alternatives that you can have. Now, when we go on roadshows, we see this change really happening. So last year, we had the biggest participation of central banks globally we ever had, 36%. Also the largest participation from Asia, around 22%. And we see that in every roadshow, the question comes up, should we now hold more dollar or maybe more euro or something else? So I think if there is a moment to challenge the status of the dollar, it's today. And I actually also wrote down Christine's comments of yesterday, because she made the point that 2025 may be the year that the world would start to turn away from the dollar. Think about that. So maybe we are living the history today.
Thank you, Kalin. So it's time to challenge the US dollars. It's maybe time also to challenge their position in sustainable finance. So let's move to this topic as well. While, of course, the ESM has not been able to issue sustainable bond itself, there's a growing interest and growing commitment as an investor. So this time not as a borrower, but as an investor in ESG labeled bonds. And you've announced recently that ESM's investment in ESG labeled bonds had increased from 5.2 billion euro in 2023 to 7.4 billion euro in 2024. So it's a huge 2.2 billion euro increase in one single year. It's quite striking. And of course, it aligns with the Europe's green and social priorities. So what do you see as ESM's role as an investor when it comes to accelerating investment for the green transition and the sustainable development?
Yeah. Well, ESG has become less popular to talk about, especially in a changing environment. And I shared once with Julie that I was on a roadshow with my team in New York, and we met one of the pension funds. And when we wanted to go to the ESG pages, they said, no, don't go there, because you become uninvestable. Can you imagine that the mindset shift that you have in the United States around this topic? Now, that climate change, ESG is important. There is no better day to look at it as today. 37 degrees in Luxembourg, public schools are closing. My kids go to the European school, so they could choose whether to go to school. So if we see, and we don't have air conditionings in most of the buildings, because we are building buildings the way they were used to be 20 years ago, to keep heat inside, not to let it go out, which means a completely mindset. So we as ESM see 3 mega trends for the next 50 years in Europe. And one of them is still climate change. So for us, it's still on the top of the agenda, and the number of extreme weather events that are happening are increasing. The cost to that are also increasing. The floods in Slovenia 2 years ago were 15% of GDP. We need to find the money to do this. So that's why we as ESM say, well, our investments are the way we can push the ESG story, and we have 80 billion paid in capital. As you said, last year we added 2.2 billion in labeled bonds. So green bonds, social bonds, ICMA verified, so International Capital Markets Association, in order to show that this is a asset class we believe in. It fits our investment mandate, it performs well, and it's just the right thing to do. I think we need to keep investing in ESG. If it's not for our generation, it's for the next generation.
I cannot agree more, as you know. And now, well, let's move to SIU to conclude. Last question around the pool. We need to create an investment culture in Europe. So what shall we do, in your opinion, to make sure that we can shift the mindset of European investors? You shared with me recently that Kristalina Georgieva, the IMF chief, visited the ESM recently and reportedly said that shame on us if we don't act now. There's a clear momentum indeed to act around SIU and make sure that we manage the competitiveness of Europe, the attractiveness, so based on everything that has been shared so far, from the outperformance of our capital markets to the attractivity of the euro, to the momentum around sustainable finance. So what really lack today in Europe is this investment mindset. Claude Marx also ended his speech with the need for financial education, which is of course closely linked to the European mindset. So in your view, Kalin, what's the best way to encourage and incentivize European savers to invest clearly, concretely in the European real economy?
Yes, thanks, Julie. I think Claude indeed mentioned the big numbers. We sit on 10 trillion of savings in our account. So if we say we cannot invest in our economy, what else can we do than using these 10 trillion? If we would be Americans, 8 trillion can go into the market. Exactly the same numbers that were mentioned by Claude. Now, the question is also to you, how many of you are investing? Very good. How many of you invest in European safe assets? EIB bonds, EU bonds, EFSF bonds, ESM bonds. If you would be Americans, you would all hold US Treasury bonds or bills, which shows me that I see 0 hands that come up. You can use your BCEE app and actually find the EU bonds, EFSF bonds, ESM bonds and buy them. But that is for me one of the most striking examples that people might take the easiest way to invest, which is some sort of mutual fund that the bank offers them. But very few really go into depth like you do in the US. So for me, the nice thing about the Savings and Investment Union renaming and rebranding is it touches more the citizens. So you save money, you need to invest the money. You move it from your bank accounts into the private sector. So the retail side, I think, is quite powerful of Savings and Investment Union. But for me, as the CFO of a large institution, is the wholesale part that really matters. And I was part 5 years ago, and you know that, Julie, of the Capital Markets Union high-level group, where with different CFOs, CEOs, we looked what we want to change. And out of that, there were 130 recommendations. How easy is it to implement 130? Almost impossible. So we drilled it down to 5 game changers. So the first one is supervision. You need to think about how to create more European supervision. The second, securitization. If you look at Europe versus the US, Europe and US securitization market 2008 was around 80-90% from each other, so Europe was not that far away. Today it's only 7%. In the US securitization grew, in Europe it completely disappeared. Then safe assets. You need a European curve to price off your financial assets. The fourth one is a channel for SMEs, from venture capital to IPOs, that we have more bell-ringing ceremonies like you have at the stock exchange, but then across Europe at the Euronext, Nasdaq, and other places. And finally, to have more strategic finance. A few years ago, this was ESG. Now it's maybe more defense finance. I don't care, but as long as we focus the money on the right things that really focus our economy. So. And what you referred to our meeting with Kristalina Georgieva. She said, if you look at the geopolitics now today, we have from the west, we are attacked, we are challenged from the north, from the south, from the east. If there is one moment that this needs to move, has to move now. If we don't move it now, shame on us.
Shame on us, indeed. I think we are all convinced, and the topic you just mentioned, so linked to supervision, the securitization, is also part of the discussion today. Channel for SMEs, of course, is also a topic of interest, especially for the stock exchange, and of course part of the SIU, and more strategic finance. Lots of debate also around defense. Maybe let me add also that we also need to work with new technologies and also embrace digital finance, and I think that's also something that will be discussed during the program this afternoon. Thank you very much for having been with us today, Kalin. Thank you for sharing your insights and European perspective on the SIU and the European attractiveness. Thank you very much.
Thank you very much, Julie. And if I can say one thing, it is fantastic to actually see so many capital markets enthusiasts here. And I think that's one thing that Luxembourg really needs to grow, is people like you and to be part of that. And if you're passionate about this topic, the 1st and 2nd of October this year, we have a flagship event, which is also co-sponsored by the Luxembourg Stock Exchange, organized by EFSF, ESM, EU, and EIB. I really hope many of you can join it. You can check it out on our website, but I think that is another boost for the capital markets community here, so we can continue that conversation. Thank you.
Thank you very much.